Have you ever wondered how some people effortlessly build wealth while others struggle with debt? It's a question many of us consider as we manage our money. You might have heard the phrase, debt is the root of all evils, and even felt that way when drowning in debt. It can feel like your life is over as your debts grow day by day, with interest piling up. But what if I told you there are powerful strategies involving debt that rich people use to build their fortunes? It might sound surprising, but if it weren't true, why do some people get rich so quickly? The key lies in understanding how to leverage debt effectively. Instead of seeing debt as a burden, wealthy people use it as a tool for creating more wealth. In this video, we're going to explore these strategies and show you how to turn debt into a powerful ally in your financial journey. Get ready to discover the secrets that could transform your financial future. So let's dive into the 15 ways rich people make money with debt. 1. Trade financing. Trade financing is crucial for global commerce, enabling businesses to buy products on credit and pay suppliers post-sale. This strategy minimizes upfront costs, allowing companies to scale efficiently. For example, a company could import pens from China, sell them in the US, and pay the supplier later, optimizing growth potential. In 2022, the global trade finance market was valued at over $10 trillion, highlighting its importance in international trade. Alibaba uses this model effectively, helping businesses boost sales without initial investments. Consider owning a US online store selling tech gadgets. If you find a supplier on Alibaba with the latest smart home devices but lack funds, trade financing allows you to buy on credit. You sell the products first and pay the supplier later, expanding your product range and customer base with minimal initial investment. Similarly, Trendywear, a European fashion retailer, leveraged trade financing to import sustainable clothing from India, enhancing its brand and increasing sales by paying suppliers post-sale. These examples show how trade financing helps manage cash flow, grow businesses, and seize new opportunities, proving vital for sustainable growth in today's interconnected market. Continuing from the benefits of trade financing, let's delve into another valuable asset that can significantly boost your wealth. 2. Real estate refinancing. Real estate refinancing is a powerful tool that wealthy individuals use to unlock the equity in their properties, allowing them to reinvest and grow their wealth. By refinancing properties after increasing their value through renovations, they can pay off the original mortgage, cover renovation costs, and still make a profit. For example, purchasing a rundown property for $500,000 and spending $100,000 on renovations might increase the property's value to $800,000. Refinancing this property based on its new value allows the owner to pay off the original mortgage, cover the renovation costs, and still have funds left over. According to the Federal Reserve, residential real estate appreciation averages around 3 to 5% annually. Cities like Austin and Phoenix have seen property values soar by over 20% in recent years, making real estate refinancing a highly profitable venture. This approach is also viable for smaller investors. Suppose you upgrade your home's kitchen and bathrooms, adding $50,000 to its value. Refinancing could let you tap into this equity to pay off debts or invest in more property, enhancing both your living space and financial standing. With U.S. property values continuously rising, an average appreciation rate of 7%, refinancing offers a valuable opportunity for homeowners to leverage their equity for further investments. Moving on from the benefits of real estate refinancing, let's explore how financial instruments can offer high-stakes investment opportunities. 3. Hedge funds. Hedge funds use debt to enhance returns, often earning significant profits even when stock prices fall. These funds engage in strategies like short selling, borrowing shares, selling them at current prices, and planning to repurchase at lower prices. For example, if a hedge fund expects a stock to drop, it might sell borrowed shares at a high price and buy them back cheaper, capturing the profit. Valued at approximately $5 trillion in 2023, the global hedge fund industry is projected to reach $5.47 trillion by 2029, highlighting its pivotal financial market role. The 2021 GameStop short squeeze illustrated the risks and rewards of such strategies, with funds like Melvin Capital suffering substantial losses when retail investors inflated the stock price. Individual investors can also employ hedge fund tactics on a smaller scale. For instance, if you assess a stock as overvalued, you might short sell it via your brokerage account. Although this requires understanding market risks, It offers a potential profit avenue from declining stock prices. In 2024, hedge funds are adopting blockchain technology to improve transparency and reduce costs, boosting their ability to forecast market trends and fine-tune trading strategies. This tech integration is expected to strengthen hedge funds' capabilities in managing complex market dynamics. Next, let's shift our focus from hedge funds to another significant market, the foreign exchange. Forex Trading. Forex trading is a high-leverage environment where substantial profits can be made from currency fluctuations. Traders can control large positions with relatively small initial investments, enhancing potential returns. For example, if a trader predicts that the euro will strengthen against the dollar, they can use leverage to amplify their profits. By borrowing funds, they can take a large position and benefit from even slight shifts in currency values. In 2024, with over $8 trillion traded daily, the Forex market is one of the world's largest and most liquid financial markets. Major financial institutions like Goldman Sachs and JP Chase utilize advanced algorithms to trade currencies, reaping significant profits through strategic leverage. Individual traders can also exploit Forex trading opportunities. Using a Forex trading platform, a trader might start with a modest investment and employ leverage to trade currency pairs. Accurate market forecasts can dramatically increase returns, but understanding the risks is crucial. For instance, a $1,000 investment with a 101 leverage ratio allows control over a $100,000 position. A 1% market movement could double the initial investment. However, the potential for high returns comes with high risks. Extreme leverage can lead to significant losses, and in volatile markets, traders can lose their entire investment. This dual nature makes Forex trading both attractive and challenging, emphasizing the importance of meticulous risk management to prevent severe financial losses. Now that we've discussed the dynamics of Forex trading, let's consider the critical role of credit scores in securing favorable financing. 5. Credit score optimization. A high credit score is crucial for obtaining loans with favorable rates, and affluent individuals often focus on maintaining excellent credit to access superior financing options. For example, a borrower with a credit score over 750 may receive a 3% mortgage rate, whereas one below 650 could face rates above 5%, potentially costing thousands more over the loan's life. As of April 2024, the average U.S. credit score reached a new high of 716, emphasizing the value of creditworthiness in financial planning. Enhancing your credit score involves straightforward strategies like timely bill payments and reducing credit card debts, which can notably improve your score and result in better loan terms. Recent changes in credit scoring now include alternative data like utility and rental payments, offering a broader perspective of an individual's financial reliability and helping more people boost their scores. Credit scores also vary by age and income. Younger people generally have lower scores due to shorter credit histories, with those aged 29 averaging 674, while individuals over 75 average 758. Higher income earners typically have better scores. For instance, high-income families average a score of 774 compared to 658 for low-income families. There are also racial disparities in credit scores, with Asian Americans averaging the highest at 745 and Black Americans the lowest at 677. However, there is little difference between the average scores of men and women, with scores around 705 and 704, respectively. Maintaining a high credit score is essential for securing beneficial financial opportunities, and understanding the factors that affect credit scores can aid in improving financial health. After exploring the importance of credit scores, let's delve into how businesses grow through leveraged buyouts. 6. Leveraged buyouts, or LBOs. Leveraged buyouts are popular among private equity firms, which acquire companies using significant borrowed money, aiming to boost profitability and sell them at a profit. A notable example is KKR's acquisition of RJR Nabisco, involving substantial debt to later sell the company at a higher value. In 2023, the global LBO market saw deals worth over $450 billion, with Thoma Bravo's $12.3 billion acquisition of Proofpoint highlighting the strategy's ongoing profitability. Small businesses can also utilize LBOs. For example, if you run a successful local business and plan to buy a competitor, You could finance this with a loan. Integrating the new business to boost profitability allows you to repay the loan and significantly expand your enterprise. The healthcare sector has seen an increase in LBO activity, driven by private equity firms leveraging growing demands for medical technologies and services. While LBOs offer substantial potential returns, they involve risks due to high debt levels. Conducting thorough due diligence is crucial to ensure the target company's cash flow can support the debt repayments. Developing a solid integration plan is essential for achieving synergies and profit gains after the acquisition. Consulting with financial advisors and legal experts is advisable to effectively structure the deal and mitigate risks. Continuing from leveraged buyouts, let's explore how wealthy individuals use leverage in the stock market. 7. Stock market leverage. Using margin trading, investors can borrow money to buy more stocks, thereby amplifying potential returns. Wealthy investors like Warren Buffett have successfully used leverage to enhance their stock market gains. For example, Buffett has employed margin trading to increase his investment positions, borrowing funds to maximize returns. This strategy can yield substantial gains if the investments perform well. As of May 2024, margin debt on the New York Stock Exchange reached a record high of $810 billion, reflecting widespread use of leverage to boost returns. Individual investors can also engage in margin trading. For example, if you're confident about a stock, you can increase your investment through margin via your brokerage. This method can significantly boost potential returns. But managing risks is crucial. Recent regulatory updates have made margin trading safer for individuals by enhancing protections. However, while margin trading can increase your returns, it also raises the risk of substantial losses. Implementing a robust risk management strategy, like setting stop-loss orders, is vital. It's also important to fully understand the terms of your margin account, including interest rates and margin calls. Shifting from the stock market, let's consider how entrepreneurs use debt strategically to expand their businesses. 8. Business expansion loans. Business expansion loans are essential for entrepreneurs aiming to increase market share and profits. By borrowing to invest in infrastructure, technology, and other growth areas, businesses can quickly scale. For example, Amazon used significant debt early on to establish its extensive warehouse network, helping it dominate the e-commerce market and achieve a market capitalization of about $1.85 trillion by July 2024. Strategic borrowing can significantly enhance growth and long-term profitability. Consider a small bakery looking to expand. With a business expansion loan, it can open new locations, upgrade equipment, and hire more staff, boosting sales and competitiveness. For instance, Magnolia Bakery in New York used a loan to grow globally, while Better Buzz Coffee in California expanded into multiple new markets, substantially increasing revenue. When exploring expansion loans, it's critical to assess your financial situation and future revenue prospects to ensure profits can cover repayments. Shop around for the best loan terms and consider consulting a financial advisor to align the loan with your business goals. Effective planning and risk management are crucial for successfully leveraging loans for business growth. Now that we've covered business expansion loans, let's move on to how short-term financing solutions can bridge financial gaps. 9. Bridge loans. Bridge loans are vital for short-term financing, helping to cover gaps in large transactions and ensure smooth operations. Real estate developers frequently use bridge loans to quickly secure properties while arranging long-term financing. For example, a developer might use a bridge loan to swiftly purchase a property and then refinance with a long-term loan after renovations are complete. In 2023, the U.S. bridge loan market was valued at about $45 billion, highlighting its importance in property development and business acquisitions. Consider owning a small construction company that needs to buy land for a new project. A bridge loan allows you to secure the property immediately, providing the time needed to secure permanent financing. This can help you capitalize on opportunities without delay. For instance, a developer in New York utilized a bridge loan to purchase and renovate a historic building into luxury apartments, greatly enhancing its value. When leveraging a bridge loan, it's crucial to have a solid exit strategy in place. Plan how and when you'll repay the loan, whether it's through refinancing, selling the property, or other means. Be aware of the loan's terms and interest rates, and ensure the short-term benefits justify the costs. Moving from bridge loans, let's explore the flexibility provided by credit lines for both businesses and individuals. 10. Credit lines for flexibility. Maintaining lines of credit provides businesses and individuals with quick access to funds for investments or emergencies. Small businesses often use credit lines to manage cash flow and seize growth opportunities without financial strain. For instance, a small business might have a $100,000 line of credit with a bank, enabling it to handle unexpected expenses or capitalize on sudden opportunities. In 2023, the U.S. Small Business Administration facilitated over $25 billion in credit lines, aiding businesses in overcoming economic challenges and investing in their expansion. Consider a freelance graphic designer who utilizes a line of credit to buy new software and equipment for a large project. This flexibility allows the designer to meet client demands without financial pressure, enhancing their capability to deliver quality work and expand their business. Similarly, a local bakery might use a line of credit to purchase ingredients and equipment for a significant catering contract, fulfilling the order and securing repeat business. When using a line of credit, it's crucial to do so responsibly. Draw on the credit only when necessary and ensure you can repay the borrowed amount promptly to avoid high interest charges. Monitor your spending and repayment to maintain a healthy credit score. With credit lines providing flexibility, let's consider how debt is used strategically in real estate development. 11. Real estate development loans. Real estate development loans are crucial for developers to fund property projects and secure high returns upon completion. Developers borrow to build new properties and sell the finished units profitably. For example, a developer might borrow $1 million to construct a residential complex and sell it for $1.5 million. In 2023, the U.S. commercial real estate development market generated $1.3 trillion in economic activity, demonstrating the value of strategically financed projects. Firms like Blackstone and Brookfield Asset Management use debt to finance significant developments, creating substantial value. Consider a local developer who takes out a loan to build an apartment building in an expanding neighborhood. Once completed and fully leased, they can sell the property at a premium, repay the loan, and realize the profits. This method allows developers to pursue larger projects and increase earnings. For instance, a Miami company achieved a 30% return on investment from a mixed-use project financed through development loans. When securing a real estate development loan, it's essential to have a comprehensive and realistic project plan, including timelines and budget forecasts. Perform a thorough market analysis to confirm demand for the project, maintain a contingency fund for unforeseen costs, and keep open communication with your lender. Moving from real estate, let's delve into how equipment financing enhances operational efficiency. 12. Equipment financing. Business expansion loans are vital for entrepreneurs looking to increase their market share and profits. By investing in infrastructure, technology, and other growth areas, businesses can quickly scale. For example, Amazon leveraged significant debt to build its warehouse network, propelling its market cap to approximately $1.85 trillion by July 2024 and establishing a dominant e-commerce presence. Magnolia Bakery in New York City, for instance, used a business loan to expand and now operates multiple global locations. Similarly, Better Buzz Coffee, a coffee chain in California, utilized a loan to open new outlets across Southern California and Arizona, significantly enhancing its revenue. When considering an expansion loan, it's crucial to evaluate your financial situation and projected revenues carefully. Ensure the expected profit increase will cover the loan repayments. Comparing loan terms and rates and consulting with a financial advisor can help align the loan with your business goals. Now that we've explored equipment financing, let's discuss how tax advantages can enhance financial gains through strategic borrowing. 13. Tax-advantaged borrowing. Loans with tax benefits reduce taxable income and overall tax liability. Mortgage interest deductions, for example, allow homeowners to save on taxes while investing in real estate. Homeowners can deduct mortgage interest from their taxable income, significantly lowering their tax burden. In 2019, U.S. taxpayers claimed over $72 billion in mortgage interest deductions, highlighting the substantial financial benefits. Businesses can also benefit from tax-advantaged borrowing through Section 179 deductions, allowing them to deduct the full purchase price of qualifying equipment and software. For example, a small business owner might take out a loan to purchase $50,000 worth of new machinery. By utilizing Section 179 deductions, The owner can deduct the full amount from their taxable income, reducing their tax liability and effectively lowering the cost of the equipment. Section 179 deductions were expanded, allowing businesses to deduct up to $1.08 million, making it an even more attractive option for financing necessary equipment. A local bakery used tax-advantage borrowing to purchase energy-efficient ovens, qualifying for additional tax credits and reducing their overall costs. After considering tax advantages, let's explore how startups utilize venture debt to fuel their growth. 14. Venture debt. Venture debt provides high-growth startups with loans in exchange for potential equity conversion, offering high returns if the startup succeeds. This financing method balances risk and reward for investors. For instance, a venture capital firm might provide $2 million in debt to a startup, with the option to convert the loan into equity if the startup is successful. The global venture debt market reached $25 billion in 2020, reflecting its growing importance in the startup ecosystem. Silicon Valley Bank and Hercules Capital specialize in venture debt, supporting the growth of innovative startups in technology and life sciences. A tech startup developing a groundbreaking software platform might secure venture debt to fund its operations and product development. If the startup achieves its growth targets, the venture debt can be converted into equity, providing significant returns for the investors. A biotech startup in Boston used venture debt to finance the development of a new drug, ultimately leading to a successful IPO and substantial returns for the investors. Finally, let's delve into how corporate bonds serve as a significant method for companies to raise capital. 15. Corporate bonds. Companies issue corporate bonds to fund growth and development initiatives. For example, Apple has issued over $120 billion in bonds for research, development, and acquisitions, using debt to enhance its market position. In 2022, Amazon raised $12 billion through corporate bonds at historically low interest rates to finance its expansion and boost its competitive edge. Corporate bonds are a crucial part of the global debt market, which exceeded $130 trillion in 2023. They are used by companies in various sectors, such as a renewable energy company issuing green bonds for solar and wind projects, or a tech firm in Silicon Valley raising funds for AI development, thus attracting investor interest and driving innovation. The first quarter of 2024 set a record for investment-grade bond issuance, with $658 billion issued, demonstrating strong demand and the ongoing reliance on corporate bonds for financing. This highlights their significance in supporting strategic corporate growth across industries. And there you have it, 15 ways rich people use debt to build wealth. By adopting these methods, you can use debt to boost your financial portfolio, create multiple income streams, and ensure a prosperous future. Remember, building wealth isn't about quick fixes. It's about making smart decisions and giving your investments time to grow. Start with what you have, stay disciplined, and watch your financial situation improve. If you found this video helpful, please share it with friends and family. Don't forget to like, subscribe, and hit the notification bell for more financial success tips. Thanks for watching, and best of luck on your financial journey. See you in the next video.